let's look at the bond market, because it is actually way more important than the stock market. First off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. We will look at some of the leveraged ways to trade bonds. You have this one. If you are feeling bullish, and that one gives you, 3 times exposure to the 20-year Treasury bonds. And the TLT is, the underlying index. If you are feeling bearish, you do have the TMV. You're looking at the performance. We got, 16-ish% gain from the bulls, 43 here for the bears. Okay, so we will look at the TLT. Here you have the bullish one, and here is the bear. First off, we want to look at the seasonality for the TLT. Like that. Okay, so here are the last 20 years. The issue is that we don't have any really strong seasonality for the current month or the coming months, because even like 61% of the time it closes higher than it opened. It isn't 50-50, but it isn't far from 50-50. The only really strong seasonality we have is for August, which is very bullish, and then you have October, which historically is very weak. But beyond that, it hovers between, it's 50-50. So here is the chart. So seasonality was not really that helpful. Here are the weekly data points, the TLT, all the data I can get here, and you can see that it does move in these waves, hence it actually is pretty well suited for these leveraged products, bull or bear. Because if you, as an example, look at this pullback here, down to this low, that was approaching minus 20%, and if you use a leveraged product, that could become rather significant. This rally here, if we take it to this top, 34-ish%. What I find very interesting right now is that the blue 100-week moving average, test. You can see that the tests have been relatively surgical. Sometimes we slip a bit below it. As resistance level here, test, but it was, failed breakouts. So it is pretty clear based on the data that the 100-week moving average in blue is important. Now we are testing it again. We have had a pretty significant pullback from this intra-week high to the recent low that is approaching minus 18%. Pretty significant. Hence, you could argue that the bears, they have they've had a lot of fun here. It is very much possible that now that we have reached that key moving average, that the bears, at least a significant number of bears, are going to consider taking some profits. When we look here at accumulation distribution, we do see that even though there's been a relatively significant pullback, throughout this pullback, we haven't seen, a very sharp increase in sellers. So there is some significant buying pressure. So that's interesting. So there is some bullish divergence here. Looking here at RSI, historically, these kind of low levels, they tend to entice the bulls. It is rare for us to become even more oversold. It is possible that we are going to go down here and test the 200-week moving average. That obviously would be very bad, for the bulls. And that would happen if the 100-week now turns into a resistance level. There's some interesting things happening here. There's a 60% actually positive correlation with S&P 500. Looking at the daily data points, you can here see we are loading. Okay, here we have it. Okay, so minus 86% negative correlation with S&P 500. That is relatively strongly negative. Okay. Here you can see the accumulation distribution. I mean, we are almost at the highs we had back here and here. There are buyers. You could make the case that there is some horizontal support levels here. RSI, it's in a zone where buyers have tended to step up. If you look here at the PPO, which is measures the distance away from the 200-day moving average at this point, we have been further away before, but we have reached a level where buyers have come back, where there's basically been some mean reversion. So technically speaking, even though it's definitively not a screaming buy at the moment, there's a lot of pessimism here for the 20-year Treasury bonds. Bears are still in control. We have seen such a big pullback that it makes sense to look now for, a change, at least some mean reversion. Okay, so now let's look a bit at the correlations here with these leveraged products. So we have the TLT in the background, and then we have the TMF. That's the one if you are feeling bullish. And here we can see 99% correlation long term. That is really good. Short term, 99.8. That's extremely good correlation. That is really good. That's very impressive. Okay, let's look at the TMV. That's the one if you are feeling bearish. Okay, here of course investing.com has not been able to recalculate. This is an issue with investing.com. They are terrible at recalculating charts after a stock split, and that basically ruins some of the analysis here. We do, however, have a 57% correlation here, and then on the daily data points. On the daily data points, we do have a minus 99% negative correlation. Okay, so there is a strongly negative correlation, and that's it. That is what we would like to see. But yeah, I will send and if you use investing.com and you see these kinds of messed up charts, just send a complaint right away because they will never fix this issue if people do not complain. Given that we did see this negative correlation on the short term between the TLT, the underlying benchmark, and the S&P 500, it is a bit interesting to look at the S&P. Because some weakness in the S&P could be, bullish for the TLT. So one of the things I like to look at least recently, that is signs of the possibility for a mean reversion. And if you look at the PPO, we can see that we haven't been this far away from the 200-day moving average since back here, at the beginning, after the financial crisis. So there definitively is excess in this market. We are very much due a more meaningful correction. But when bulls are euphoric, it is problematic to be short. You got to be a bit careful. Like I'm a huge fan of having like a long short portfolio, but because that enables you to be market neutral. But it's definitively been more frustrating because the long trades have been working out really well, but the short ones have they become stopped out very fast. But looking at long-term horizon, market neutral portfolios, they generate substantial alpha. So yeah, it is very important because if you are not market neutral and let's say that you are full bore bullish, you are completely long this market, the stock market, that's when you get just eviscerated during a pullback. Because if the stocks pull back, if your portfolio pullbacks 50%, you need a 100% gain to get back to even. That is how percentages work. And that is one of the reasons why it is you can generate enormous alpha by, of course, being market neutral. Another thing is to buy low and sell high. So participate in the biggest moves up, but to avoid the biggest drawdowns.